Hi everyone, it's Peter Schiff. This is Friday, June 25th, 2010. Well, this morning the government released its revised estimate for first quarter GDP growth, and it was revised down from the original estimate of 3.2% down to 2.7%. And of course, this isn't really economic growth. This is simply the result of spending the stimulus money. Of course, we had to go into debt to spend that money, and when the stimulus wears off and the hangover sets in, there's going to be a big price to pay for this phony economic growth. All we've done is dig ourselves into a deeper ditch. Of course, this week economic data is coming following a week filled with weaker than expected data, particularly if you look at the housing markets. Now, the stock market reacted pretty calmly today. The Dow, I think, finished off about 10 points. In terms of gold, the Dow is now worth about 8.2 ounces. Gold itself was up about $15 an ounce today. Gold stocks were very strong. The HUI finished the day up about 3.5%. That's the Gold Bugs Index. In fact, that index closed at its highest weekly level in more than 2 years. Oil was also very strong today, up about $2.50 a barrel. We closed at $79. It looks very strong. The dollar had a very interesting day. Look at the Australian and New Zealand dollars. They had outside days to the upside, where they took out the previous day's low and then closed above the previous day's high. The dollar index had the opposite pattern. It had an outside day down, where it took out the previous day's high and closed below the previous day's low. Also, if you look at some of the other currencies, I think the euro is really completing a head and shoulders top on the daily chart. And I think the dollar index is, a head and shoulders bottom on the euro, excuse me. And I think the dollar index is putting in a head and shoulders top. So I think I would go out on a limb, and I think I'd say that the bear market rally in the dollar is ending. And I think the dollar has a lot of downside to go from here, particularly as we put a little distance between where we are now and that neckline. Now, a lot of this jives with what's going on in the real world. In my last commentary, I talked about Alan Greenspan's op-ed, in which he correctly warned that the U.S. should address the deficit right now, that we can't afford to let it get bigger, that the argument that we need growth before fiscal prudence is wrong, that if we cut the deficit now, that it's going to derail the economy. Greenspan's point was no. If we don't reduce the deficit now, we will derail the economy, which is my point. The economy can't grow with all this deficit spending. Well, Paul Krugman, of course, ran an article this week in the New York Times basically disagreeing with Greenspan, saying that what we need is more debt, more government stimulus, that Greenspan was wrong. Now, in Europe is following Alan Greenspan's advice. Europe is announcing real austerity, real government cuts in the Eurozone and in the UK. In the United States, we are ignoring Greenspan, and instead we are following Krugman. In fact, we went to Europe in this G20. We tried to convince the Europeans to follow our model, to not address their deficits, to instead keep on spending and keep on stimulating, and they had the good sense to reject that very bad advice. But it seems to me that the currency markets are already voting. If you look at the strength in the pound and now the strength in the euro and the strength of gold, you can see that the currency markets are voting that Europe is right and that the United States is wrong. And in fact, if that is the case, then what are we doing? We are going to get a weaker economy because of all these deficits, and the deficits themselves are going to be bigger. So by the time we get around to doing the right thing, cutting government spending and addressing the deficits, there's going to be a lot more pain associated with the austerity because we made the problem worse before we actually get around to solving it. Also, I want to talk today about this financial regulation bill that's finally getting passed. And of course, the goal here of financial regulation is to try to prevent the next financial crisis. Well, first of all, even if this bill had been passed in its entirety 3 years ago, 4 years ago, it wouldn't have prevented the financial crisis. The housing bubble still would have inflated, and it still would have blown up. All the problems would still be there. So this bill would have done nothing about the last crisis, let alone heading off the next financial crisis. It's not going to do that. All this is smoke and mirrors so that Congress can pretend that they've done something. But of course, the one thing they do accomplish is tax increases and more regulation, which is what they run it all along. But it's not going to protect the economy. It's not going to protect the consumer. It's not going to protect the taxpayer. It's just going to expose them to greater danger. Higher taxes, higher fees. I mean, first of all, one of the things that the bill does is it actually codifies the too big to fail doctrine. It actually has a process to make firms too big to fail. This is going to lead to larger systemic risks, not smaller. And of course, all of the new fees associated with compliance with these new rules and regulations are going to make our financial industry less competitive globally, less efficient. The cost of all these added regulations are going to be passed on to the end user, their customers, American citizens. You know, one of the things they made a big deal about is they're going after, the fees on debit cards. Right? First of all, how much could these fees actually be? You know, the fee on a debit card can't be that much. You know, what are you talking about? A few pennies, maybe a few dollars here and there over the course of the year. What is the average American paying for the convenience of using a debit card? Probably very little. It's probably better than having to go to the bank and wait in line and get your cash, or having to stand there and write checks. I think whatever we pay for these debit cards, I think it's a bargain. But the fact is, the government makes a big deal about it. You know, what's really a big deal is not what we pay for our debit cards, but how much we pay in taxes, the federal income tax, the payroll tax, the Social Security taxes. You know, that's a huge expense. Instead of trying to save us a few pennies on our ATM fees, why don't you cut income taxes? Why don't you reduce the payroll tax? Why don't you cut government spending? Really do us a favor. This stuff is nonsense. Besides the fact that the government has no right telling a bank what it should charge for one of its services. Let the market determine what somebody should pay for a debit card. And if the consumer doesn't like it, there are plenty of banks. You can use a different debit card, or you don't have to use a debit card at all. This is ridiculous for the government to be setting these rates. And of course, what are they going to end up doing? They're going to find another way to stick their customers with these costs. Maybe it's going to be an indirect way, but the consumer is going to end up paying for it. Also, in this bill, they're creating this systemic risk regulators, I think, as part of the Federal Reserve to find these systemic risks in advance, right? Well, remember, these are the same clowns that didn't see the real estate bubble, that didn't see the stock market bubble. Not only didn't they see it, they were staring at it and they denied it existed. So if the Fed couldn't see the biggest bubbles in our history, even though they were about to burst in their face, why does anybody believe that their vision is going to be any clearer in the future? I mean, the whole thing is nonsense. The only way we can really head off systemic risk is to get the government out of the way so that the market can rein in these risks. You know, the biggest systemic risks out there are Fannie Mae and Freddie Mac. And this bill does nothing to address that problem. In fact, they tried to stick the cost of a future Freddie and Fannie bailout onto the banks, and they didn't want any part of it, which is, you know, I don't blame them, because such a bailout is going to cost well in excess of $1 trillion. You know, who's going to end up footing the bill for that bailout? You know who it is. It's going to be us. It's going to be the taxpayers, people who own U.S. dollars. That's the real elephant in the living room that nobody wants to address. So the whole idea that they are going to spot these systemic risks is nonsense. In fact, all of the systemic risks are still there. You know, Freddie and Fannie are still guaranteeing mortgages. The FHA is guaranteeing more mortgages than ever before on flimsier collateral. The government is still guaranteeing the bank accounts. The government is still providing the equivalent of a Greenspan put. So all of the ways the government artificially interfered with the market are still there. And of course, more important than ever, interest rates are still zero. They're still giving money away. What about the systemic risks associated with interest rates being too low, with encouraging and subsidizing reckless spending and debt? That is a risk that they do absolutely nothing about. And of course, also, there's going to be more regulations, not only of banks, but of brokerage firms. I'm sure my little firm, Euro Pacific Capital, is going to get hit with all kinds of new regulations, which is going to diminish my ability to deliver the best service to my customers. I'm sure ultimately it's going to result in higher fees that I'm going to have to pass on to my customers. And I'm sure that some of these new rules and regulations will drive some of the smaller players out of business, which is exactly what the government wants, so they can help make their buddies at these too big to fail firms even bigger. Anyway, that's it for today. Have a great weekend, everybody, and I'll be back again soon. Take care.